Index fund investing. Have you ever just wanted to grow your wealth the easy way and even earn passive income with very little work? Yeah, me too. Unfortunately, there really isn't a way to do that. All the methods that you hear about online really require you to put in the time and effort to get any real results. Like, for example, if you're doing Shopify or Amazon FBA. Other ways really require you to get deep into research when it comes to investing in dividend-yielding stocks. If only there was a way that I could just put my money into an investment vehicle and let it grow and pay me for years to come. Wait, are you saying that there is? Why haven't I heard of this before? And why is there dramatic music playing in the background? Will you explain to me what this magic tool is before you cut away? What's up, guys? You're watching Finance Squared. I'm your host, Derek West, and in this video, we're talking about investing in index funds, the hows, the whys, the strategies behind it, and why index fund investing is really all the rage in the investing world right now. And also, could it be the next financial instrument that causes another Great Recession? I mean, after the last Great Recession that was caused by that Rona. But to understand why index funds are all the rage, you first need to understand what in the heck they are. You see, a long time ago, in a land far, far away, people realized that they shouldn't simply own one stock, as it left them at a severe risk of losing all their money if and when the stock comes up snake eyes in the market. So people started to buy multiple stocks, thus diversifying their portfolios. But realizing that this was a cumbersome process that could become expensive, investors sought a way to buy all those stocks at once in a single entity. And along came the mutual fund. Investors, for a while, were quite contented with the instruments that they created. But these mutual funds, while lucrative, oftentimes were laden with fees. Investors soon realized that, hey, this thing really is just following an index. When it rises, and when it falls, it falls. The person managing it may or may not be doing a good job, but he or she may not be worth the price that I am paying to attempt to beat the market. And along came index funds. You see, an index fund is really just a passively managed mutual fund that tries to duplicate the performance of a financial index. Think the S&P 500, or the Dow Jones Industrial Average, the NASDAQ Composite, or the Russell 2000. Index funds changed the game and simplified investing just like their mutual fund predecessors, while at the same time reducing the cost to investors. Index funds are typically thought of as baskets of stocks, and that is not inaccurate, but they can be so much more than that. Index funds can measure the performance of assets of a similar type, such as stocks, bonds, currencies, commodities, things of that nature. The great thing about index funds is that there are indexes for nearly every asset class and almost every sector of the economy, both foreign and domestic. They can track the performance of a large cap or small cap stock, with cap being market capitalization. And the smaller the cap, the larger the potential for growth. With the larger the cap, the larger the potential for stability. Indexes can track the performance of investment grade or junk bonds, the degree to which the likelihood of that bond will be paid back by the borrower. And every type and kind of commodity, from gold to oil to rare earths, etc. Index funds operate similarly to mutual funds in that they have a fund manager. The manager attempts to build asset portfolios that earn the same rate of return of a chosen index, stock, bond, etc., whatever the index is tracking. For example, a Dow Jones Industrial Average index fund would attempt to house all the companies of the Dow Jones Industrial Average, and by doing so, match the overall performance of the Dow. An index fund is a type of mutual fund, just like I mentioned earlier, and when you buy an index or mutual fund, you're really pooling your money with other investors who also bought into that fund. And effectively, you're buying shares of a company that is running that fund. That money is then used to buy stocks, bonds, commodities, whatever match the targeted index, like in our examples earlier. The Dow Jones. For example, if you bought into an index fund that tracked the Dow Jones, your fund manager would attempt to buy every stock in the Dow Jones Industrial Average. Dividends, interest, and capital gains are paid out to investors regularly. As if the choices weren't abundant enough, their index was with different characteristics, namely price-weighted indices and market cap-weighted indices. Indice is just plural for index, by the way. A price-weighted index takes into account each asset's market price. The higher the price of the assets, the bigger share it has in the index when compared to lower priced assets. Our favorite example, the Dow Jones Industrial Average, is a price-weighted index. The other type of index, the market cap-weighted index, takes into account the market capitalization. In finance whiz kid jargon, we're talking about the market cap. Translated into plain English, the total amount of money invested in the asset, stock, bond, whatever, to determine its share in the index. The S&P 500 is a market cap weighted index. Each component's market capitalization determines its weight in the index. This is an important distinction to keep in mind because with price weighted indexes, in order to adjust the portfolio to properly manage the performance of the index it's tracking, the holdings of the portfolio need to be bought and sold more often. Because as you know, prices of stocks and other assets rise and fall with a ton of frequency, meaning that the fund manager will be extra busy, meaning the expenses for the index fund could, in theory, be larger. But at the same time, with market cap weighted index funds, larger capitalized stocks will have outsized impact on the fund, both positively and negatively. If a large cap stock in the fund has a bad day, it could significantly impact the fund in a negative way. But the good thing about everything I just said is that index funds are passive, one of the only true forms of passive investments out there. You really could just put your money into the fund, let it sit there and track the index of choice, and you don't have to do anything after that except for collect the dividend checks or reinvest them to truly have your nest egg grow. Now that you have an idea of what an index fund is and how it tracks individual indices and markets, let's talk about strategies for maximizing index fund returns. So it's true, you could potentially just put all your money into one index fund and keep reinvesting your returns and probably outperform most fund managers on the planet with that strategy. But if you really want to diversify your portfolio and maximize your wealth creation, you really should follow a proven index fund investing strategy. Luckily for you, there are a couple of them out there, as you might expect, and each of them, of course, has their own pluses and minuses. Most of the strategies that are out there are depicted as lazy portfolios, mainly because they utilize index funds as their investment vehicle of choice. And index funds require very little work on the index fund owner's part, and even on a certain extent on the fund manager. Less so if it's a robo-investor. Two of the more popular lazy portfolios are the 2-fund portfolio and the 3-fund portfolio. Now I'm telling you, if they made it any simpler, a 2-year-old could invest and get rich. But what, pray tell, is a 2-fund portfolio? Exactly what it sounds like, a portfolio with 2 funds, index funds that is, popularized by some chap named Rick Ferry. The 2-fund portfolio typically has a one world equity market index fund and a total bond market index fund, with the split in the investing being about 60% in the equity fund and 40% in the bond market fund. Bond, James Bond. If you were to purchase those funds from, let's say, Vanguard, they would be, as an example, BTWSX and VBMFX. Or if they were from Schwab, they could be SWTSX and SWAGX. But those are just examples to help you get started on your search, should you think this is something that's right for you. And then, of course, there is the 3-fund portfolio, which consists of, you guessed it, 3 funds. Now, it doesn't get any simpler than this, folks. In this portfolio, the split in investments is 3 equal parts of 33% between U.S. equities, international equities, and bonds. From Vanguard, it could be VTSMX, VGTSX, and VBMFX. From Schwab, it could be SWTSX, SWISX, and SWAGX, the coolest name in all finance. What are some downsides to index funds? Now, can it possibly be all good and no bad with index fund investing? Well, it's about as close as it gets. It doesn't get much easier than putting your money into an investment and watching it grow. But come on now, let's be real. It's not always what it seems, and there must be some downside to index fund investing. And yeah, there are some downsides. Let's go over them. First of all, with index fund investing, since you will be investing in baskets of stocks, you will be getting average investing results. Depending on the index, that is still pretty good, as the S&P 500 has averaged about 11% return on average since at least 1970. Which is pretty good, considering the recessions that have occurred since then and all the other turmoil which the world has gone through. But it can be argued that with some research and a steely-eyed constitution, you could put together a very well-balanced and highly performant portfolio of your own that could easily beat an index fund. I have seen various versions of that argument floating around on the web, and they do have a minor point. If you're willing to put in the work and do the research, you can definitely find some gems that outperform the market in general, and indices in specific. The only thing with this is, though, that requires work. And if you want to be lazy and just take the approximately 11% return per year that you get from an S&P 500 index fund, then who could blame you? And doing that, you'd beat out 95% of mutual fund managers and others whose profession it is to pick stocks for a living. The other big downside to index funds and other investment baskets is that they might be masking poor performing stocks and thus leading to the next big market bubble. Michael Burry of Big Short fame, the stock analyst who famously predicted and profited from the credit default swaps fiasco that was at the center of the 2008 financial crisis. The crisis that kicked off the quote-unquote Great Recession of 2008-2009. He makes that very argument. I'm not going to claim to be smart enough to counter it at this point. Yeah, it could be that index funds and other basket fund types like exchange-traded funds could ultimately be masking and propping up poor performing companies, thus inflating their prices while the true value in them is complete junk. Or it could be that since these are weighted funds, like I mentioned earlier, whether they're weighted by asset price or market capitalization, that any underperforming asset would be accounted for. The truth is, nobody really knows what kicks off any recession, and people will continue to guess until one of them guesses right. And Michael Burry's guess is as good as mine. Probably a little better, but you get what I mean. So next, take a look at the video on the screen detailing the intricacies of exchange-traded funds. Depending on when you're watching this, that is either out there right now or in the middle of being produced, which means you need to click that subscribe button and the notification bell if you want to be in the know when it drops. And don't forget to like this video if you liked this video. And leave a comment down below if this video helped you in any way understand what an index fund is, where they came from, what they are used for, etc. It's really hard to take topics like this and make them plain to understand and also be entertaining to watch. Hope I nailed it. In any case, I'll catch you guys a little bit later. I'm gonna get out of here, take it easy, and remember, a goal without a plan is a wish, and a goal with a plan but no action is a wish list. Peace.